Welcome one, welcome all to DeFi Crypto and Airdrops, the DeFi trifecta episode with Jake Call from Builder Wealth and David from DeFi University, my two subject matter experts on DeFi that are going to take us to the next level and make sure that you guys and girls out there listening can get the high level alpha that you're looking for. How's it going, gentlemen?
It's going real well.
You take it, David. I was going to say the same thing. As always, a busy week, but a busy week is a good week. So, yep.
Awesome. Yeah, no. If any of you out there have not checked out these gentlemen's offerings, I highly suggest you do. In our description of this episode and on our channel, you can find a link to a discount to Metrics Finance, which is an amazing tool. And actually, Jake, we need to talk about having you on and giving a walkthrough on that, because it really is a powerful tool, and I don't do it justice when I talk about it. So,
we have
some
very cool stuff in the pipeline for that. Like, again, I think David can agree because David uses a lot, but it's a powerhouse if you know how to use it. And I hate to say it, but very few people, know how to use it to its fullest potential.
I'm one of them.
But the thing is, once you do, it can really change your entire portfolio. So we're working on some resources. Like, we have our AI live chat and stuff that's up and running that helps with that. We're working on an AI co-pilot. So you just be like, hey, what's this on metrics? Hey, what's that? Get quick responses. And also, we're working on like a metrics academy and everything, but I'm completely open to a full workshop, breakdown, deep dive, and everything like that. So, yeah.
Absolutely. So we have a link to that. I highly suggest you check that out. There is a free version, so you can kind of try it out and see how it works for you. You can also look up, copy and paste your wallet address, and you can actually see historically even closed positions that you've done in the past, as long as they're on certain chains. And I know you're always adding additional chains and protocols. And then David, just this past weekend, actually finally launched his DeFi Academy. It's been open for a while, but it's probably one of the most robust and affordable programs that I've found out there at only $97 a month. So, I mean, we have a link, for that as well. And if you are new to DeFi or even looking to up your game, it is a great place to go to to start learning advanced strategies, or if you're just dipping a toe in the water, want to learn the basics. It's for all levels. I mean, am I correct in that, David? I mean, I'm only part the way through it.
Oh yeah, no, 100%. And so, Mike, DeFi University, I just recently launched an investor mindset course, and the mindset course is a series of lessons, and it revolves around 11 books. So, what I found is that it's not necessarily the smartest guy or gal in DeFi that's the most successful, the most profitable. The people who are really successful are the ones who build a system and then execute that system without deviation, and are very disciplined in executing that system. And they've got to figure out the system that works for them, because the system that works for me may not be what works for you, Mike, or Jake. It may not be what works for you.
Well, half the time I don't understand the stuff you're talking about, so I know it won't work for me.
So yeah, just launched that investor mindset course. It's a series of lessons, revolves around 11 books. Recommend that most of the books, I think 9 out of the 11, you can listen to in audiobook format. So it's really, really good. But then there's also, a lot of educational content and courses on concentrated liquidity, on using different money markets. I focus on the money markets that I use most often. So that means Aave and Euler and Morpho and Camino. Jupiter just launched a lend borrow functionality. We'll take a look at that. And then there's also a DeFi concepts course, which is more of a broad overview. Every call in DeFi University is recorded, and yeah, man, we have live calls every single day. But one of my, I got to kick it back to Jake here for a second. The tool that he's built with Metrics Finance, dude, if you're serious about DeFi, then Metrics is the best screener. If you're
Mhm.
serious about simulating your positions,
Yep.
Metrics is the best simulator. And if you're serious about finding out whether you're profitable or not, well, you've got to use Metrics's tracking tool. So I mean, it's the best tool set out there for real serious DeFi professionals, I'd say.
Really
Oh, you know,
appreciate that,
yeah.
David. I would say, and we need to get you on a call with our team, David, so that way we can see how we can make it even better, um, based on your feedback and everything.
Yeah, man, for sure. I'd love to. For me, it would just come down to integrating in some lend borrow protocols.
Yeah, I know that you guys talked about that when we were discussing it before, and that would be powerful as hell. You know, not just liquidity pools, but borrowing, lending, and if somehow you could even put in there like a looping calculator to where you could simulate looping and things like that.
Definitely on the roadmap. I'm excited.
Awesome, awesome. All right, well, let's go ahead and kick off into this. So, if any of you that aren't already, Discover Crypto, our brother channel, along with Blockchain Report, Jeff, my co-host, he puts out strictly airdrop content there, and of course, Drew over at Blockchain Basement. They just I highly suggest if you're want to get the news, the based information and the latest and greatest, as it pertains to crypto and crypto markets. Great places to get that. But let's kick it off over into old Ben Cowan because I want to get you gentlemen's kind of take on some of the stuff that he's putting out. But he was putting some charts out earlier, and let me see if I can find them. He's been cranking out some charts. Let's see. Here we go. So he put this one out, and it's the crypto market cap and trend line. So, I mean, do one of you gentlemen want to, kind of walk us through that, this, and kind of what it means when you look at it?
Jake, go ahead.
Yeah, so this is a little bit funny of a chart to me. But basically, what this is supposed to represent is it's supposed to represent like a channel, essentially, that's like, I guess, it follows a specific curve, and shows diminishing returns over time, for the overall market cap of crypto. So obviously, the more and more we go up, the less and less we're going to be able to go up in the future. But this portrays the overall crypto market cap over time. Um, and I think the take here that they're trying to say is it follows this like little average pink line. Let me full screen this so I can see a little bit more. Yeah, it follows this kind of average like pink line, right? And that's like when we're above that pink line, we're gonna be overvalued. Whereas when we're below that pink line, we're undervalued. Where we're at that pink line, we're kind of at value. And that's the way that I look at it. Again, this is just one of the many like indications you could call it of being overvalued slash undervalued. And I think really to use this to its full potential, you need to include other um, kind of trend indicators with it, whether it's the halving cycle, whether it's the rainbow charts, right? Well, whatever it may be, right? Those should be included when you're looking at this, and fundamentals.
Yeah, definitely. So, Mike, Jake, the way that I view this is as an important data point. But this is just one data point. Whenever I'm building, my market bias or whatever my opinion is about a particular market, I need as much data as possible. And, just to take a look at crypto market cap on a log scale going back all time, this is valuable data, but it wouldn't be enough for me to take any action. This is just one data point, and I'll file it away in my mind and move on to the next data point. But that's what I see here.
And basically, what I wanted to use this for is kind of a segue into the discussion, where each of you think we are currently at in the markets. Because there's a lot of talk right now that the 4-year cycle is broken, that we're going to have a super cycle, that it's going to be an extended cycle, that I've even heard some people say that potentially we're moving into the bear market already. I mean, people are all over the place. So I'll kick it to David first. David, I mean, feel free to share anything, share your screen or anything, but kind of what are your thoughts on where we're currently at in the market, and what do you see, moving forward?
Yeah, sure. So let me just make sure I've got Trading View up. And I just want to make sure that you guys can see my Trading View screen
Yes.
as I'm sharing it. Okay, awesome. So, for me, when I think about where we are in terms of a market cycle, so I have never been an adherent to the Bitcoin halving cycle analysis. And the reason for that is during the first cycle, it was 2013-ish timeframe. It was just Bitcoin then. There wasn't really, didn't really have an altcoin ecosystem. I think Doge was one of the first memes that launched around that time. Okay, so that was the first cycle. The second cycle, 16, 17 into 18, I'm talking about 2016, 17, 18. That second cycle, you had Ethereum launch, and that generated this alt season with the ICO boom. Now, the third cycle, last cycle, was right here. This was the alt season that we're all waiting for. This is what happened last cycle. And last cycle, we had COVID, where the entire Western world was forced to stay home. And in the United States, anyway, we were given stimulus checks. And what did people do with those stimulus checks? Well, they bought altcoins. And what did altcoins do? Well, if this is a chart, altcoins went like that, parabolic, straight up, and for no good reason. So, I think that this last cycle was definitely skewed by COVID. This cycle, ETH launched, and then if you go back in time, there wasn't really any competition to Bitcoin. So the point that I'm trying to make here about this halving cycle analysis is that number one, you've got 3 data points, and the first data point doesn't really count. And the last data point was totally skewed by the Fed printing $4 trillion in 18 months. So take that with a grain of salt. And then now, this current, so-called cycle, we've got these ETF products, and we have, for the first time ever, real institutional demand for digital assets, and not just for Bitcoin, for Ethereum and for a handful of other digital assets also. So, I don't think that we're going to see, the negative 70% drawdowns for Bitcoin in a bear market moving forward, simply because those ETF products have, tapered off the vol of Bitcoin. And I expect the ETH ETF products to do the same for Ethereum. So, where are we in the cycle, if this is valid? And I think the reason why the cycle analysis could be valid is because so many people believe it. So, whether I believe it or not really doesn't matter. But if enough market participants believe it, then it could become a self fulfilling prophecy. And here we're taking a look at Bitcoin dominance on a weekly. We've had a really big breakdown. We've broken down below what I think is a level of support, this little bit of trend line support here. This is a weekly, so this is the 200-week moving average right here, coming in at 51%. And what I think could be in store for us is some type of a reversal in Bitcoin dominance to the upside. Now, here's why I think that could be possible in the month of September. If I take a look at traditional markets real quick, let's take a look at the S&P Cash Index, which, SPX, and today, I don't know if we closed at an all-time high or not, very, very close though. So the S&P is at all-time highs after having ripped by greater than 30% from those April lows after the Liberation Day panic. The VIX is trading with a 14 handle, and we're entering September, October, which is, seasonally speaking, a time of the year when volatility tends to uptick. So I'm painting a picture here, right? We've got the S&P at all-time highs after ripping by greater than 30% since April. Massive move. We've got VIX in 14 territory, which is very, very low levels of volatility. That tells me that market participants may be complacent. And then today, we just had NVIDIA report earnings, and their report, although the numbers are just massive, the revenue growth year on year is like plus 50%, but that's not what people are looking for. Market participants are looking for signs that this CapEx expansion from the hyperscalers is sustainable or not. It's becoming pretty clear that it's not sustainable. And so Nvidia selling off just a little bit after reporting earnings, but this is the leader. This is the bellwether for the market. Nvidia is larger than most sovereign nations. Okay, so if Nvidia actually starts to sell off a little bit, it wouldn't even need to be because of any deteriorating fundamentals for the business. It could just correct because it has run so much. And so going into September, when markets seasonally tend to correct a little bit with volatility at lows, and after Nvidia reported less than stellar earnings, the way that I'm looking at this is I think we could see Bitcoin continue to correct for another couple weeks. I think that if we look at ETH over here, I think that ETH has had, and this is a weekly, let me zoom into a daily. ETH has had a monster run from the lows at 13 and change, all the way up to printing a fresh all-time high, wicking to a fresh all-time high. But Tom Lee is not enough to support ETH. Although he has been buying ETH hand over fist, one man can't make the market go up. Any market is bigger than any one individual. So I think that Benjamin Cowan is right. And we might see some type of a reversal out of Bitcoin dominance into September and in the month of September.
Okay.
But something that I'm going to be really watching closely is ETH BTC here, Mike, because I want to see that ETH retains its leadership role. I think that ETH is the leader. And so even if we get a reversal in Bitcoin dominance, I just want to see ETH not break down in Bitcoin terms. And so that would
Gotcha.
mean basically just hold above here or maybe hold above here. So
Gotcha.
I think that throughout the rest of this year, Mike, we go much, much higher. But over the next 3 weeks, 4 weeks, a little bit more cautious. So
Gotcha. All right, Jake. What say you? I mean, that's a lot to chew and digest. Like I said, as always, I understand half of what David says, but he's really good at the end of summarizing. So in a way that I do understand. So that's perfect. Thank you, David.
yep,
Yeah,
you
well,
got it.
to basically piggyback off of what David said, like I think one of the things that you said that kind of opened my eyes a little bit, and I think you said this last week, was our previous data points aren't as valid as we think. And again, like there's always been the argument we only have 3 data points, but there hasn't really been the argument like, oh well, those data points we had COVID, and then we had the fact that we basically only had Bitcoin this run, and ETH just recently popped up. But to piggyback on top of that, I think you're right with so many people believing it to the point that it's valid and it's true, and even institutions playing with that will kind of help put that in process. But institutions wouldn't be investing into DeFi, or not, sorry, not DeFi, but crypto, in the instance where they were expecting a 70% decline in asset value, right? It just wouldn't be worth it for them. They would be targeting other assets. So I think they have more power than we think, and I think they have more control over the market than we think, to the point where when this market does dip, um, we're going to see max of 50% declines, in my opinion. And maybe those 50% declines are on Ethereum even, whereas 30, 40% are over on Bitcoin. Um, But we have to keep in mind Bitcoin is still a volatile asset. It is still way more volatile than any other asset out there. And I think it's still going to be treated as that. And while it is one of the largest market cap assets in the world, it's still going to be treated as something that's a little bit more volatile and, fluctuates more than the stock market or something like that. So, uh, yeah.
Gotcha.
And general indication of where we're going. Um, probably Bitcoin peaking at like around $150,000 is still where I'm looking. Ethereum peaking around, initially I was thinking 7, now I'm thinking 9. Um, and then obviously altcoins seeing a rip right after Ethereum. And what's interesting is uh, Ethereum has kind of set the path for Solana as well. Solana has started to follow Ethereum and be relatively correlated to that, which was not the case back when we saw Solana running, 12 months ago or so.
Well, that's actually a perfect segue into something that I was wanting to touch on. But before we do that, Ricky Romero brought up something that's I think is pertinent. That is kind of along the lines of what David was talking about with the COVID stimulus. There was news that came out where Trump is talking about using some of the revenue being generated by the new tariffs to do stimulus checks. The $1,200, famous $1,200 checks that everybody got during COVID. So I mean, how do you think that potentially could play into the markets? I mean, do you think it could be like a stimulus check 2.0 and pump the markets, or what are your thoughts there?
I mean, let's do the math. In the United States, there's 258 million adults, right? Let's just say 150 million of them are valid for a stimulus check, and I don't know the exact amount, right?
Yeah.
And they each get $1,200, and then we run the math of 28% of Americans currently invested into crypto. I think U.S. adults invest into crypto. Um, let's just say 15% to be safe were to put their stimulus checks or portion of it um, in the crypto market. Well, that right there is a total of 22.5 million people basically invest into crypto from their stimulus check. And of that, how many are actually going to invest the full amount? Probably not a lot. So I think the effect that we see on the market, like when you do the math, that's a maximum of $27 billion coming in the market, which
Okay.
isn't going to sway the market by itself, right? Because
Very
Bitcoin has
valid.
$2.2 trillion market cap. The overall crypto market is $3.9 trillion. There's $150 billion in the past 24 hours. 27 billion, while it might affect the market, it won't affect it nearly as much as it previously did. What I would be more eager to see is people that don't have crypto exposure because they couldn't have the means to have crypto exposure in the past that now do have crypto exposure, and just overall sentiment being a little bit better because there's more people investing into crypto. And that right there can indirectly cause price action and cause what do you call it, appreciation, and just general raises because of that. But yeah, that's my thoughts. Eager to hear yours, David.
Yeah, the first thing that came to mind when Mike, you shared that comment from someone on the call right now, was the very first thing was, okay, where is this data from? Where did this come from?
Mhm.
Is this even valid? Like, is this just bullshit, or is it real? So that was the first thing. And so what I did is I went on over to Polymarket, and I wasn't able to find any betting market. And so the next thing that came to my mind there was, okay, well, what would the mechanics of that actually happening look like? So, like, would Congress need to be involved? I don't know that President Trump can just, with his pen, make that law. So I don't know what the mechanics would look like of something like that. But first and foremost, I think it's probably not real. Even though he might have said it, I don't think it could actually happen. And if it could happen, then I feel like it would need an act of Congress. And I don't know, good luck with that.
Yeah.
So, rather than thinking, oh, well, there might be stimulus check 2.0, although that would be really cool, because hey, pump our bags, I'll take it. I just
I wish they'd just start paying off the debt with it. I mean, I
Yeah,
don't want, I don't want to get it. I didn't want to get the first check. I mean, it's to me. I mean, it basically like, all that trillions of dollars they printed. It was, basically just another hole in the boat. That's sinking the value of the dollar, in my opinion.
yeah,
Yeah, I just I don't think that something like that will ever happen, and I would much rather focus on the protocols and the assets that are returning value to token holders, rather than trying to speculate on whether there's going to be stimulus check bonanza 2.0 this year. So
Yeah.
yeah.
No, and both very, very valid. I mean, it's, and I very much appreciate the fact based, kind of logical take. It's you definitely need to, in investing, ensure that you keep a very even keeled, unemotional, logic and fact based mindset, because that goes back to what you were talking about earlier, David, where people that do well in investing, it isn't necessarily who's the smartest or who has the most data. It's somebody who has a structured plan and they're disciplined enough to stick to it, and they don't get swayed off their path because something is pumping and something else is shiny, and they're all over the place and they're just getting chopped out. So
Exactly.
here is something that, and I don't know if you gentlemen have you've probably seen it, but it looks like Jupiter just launched their beta called Jupiter Lend. Have you seen this?
Oh yeah.
Awesome, awesome. So I'll play this real quick. It's just a quick a couple seconds. So have either of you actually taken a look at it and tried it out?
I haven't got the chance to dive into Jupiter Lend. I've seen the announcement, but it's been on my to-do list. What's interesting is I saw that they partner with Fluid, which is
Yes.
what we were just recently talking about. So it's kind of cool to see that. And I've been getting like the little announcements and stuff like that on the Fluid deck. So yeah, I'm excited to dive in though. Jupiter's a great platform.
What about you, David?
Yeah, so I've got a question about it. So here, if I go to jup.ag, and then if we just take a look at the Lend tab,
Mm-hmm.
and let me just zoom in so that I can see your screen a little bit better here, Mike. Actually, you know what? I'm just going to do it on my end so that I can see this more clearly here. But my question about this was the native lending APY for many of these, what look like vaults over here on Jupiter. It
Mm-hmm.
looks like the native lending yields are very, very low, but that there is a significant incentivization program where there are rewards paid in the underlying. So if I supply USDT to a vault, it looks like the lending APY is 0.01%, but the rewards APY paid in USDT is 11.43%.
Mhm.
So my question is, how long is that incentivization program going to last for?
Yeah.
That's basically what I'm wondering.
Well, David, I think part of it is like I feel like they're doing, when I look at Jupiter, I look at Camino 2.0, right? That's the direction I see this going. Um, I think what they're trying to do is compete with Camino to the point where they're low borrow rates, incentivizing to have high lend rates. So they get, you already see they have $166 million in the market already. and $100 million borrowed, right? But when you look at the like borrowing USDC, you're paying 2.7%. Borrow USDT against Sol, paying 0.3%, and you're getting 10.5% to supply Sol. Like it's really good. So I think this is strictly like a marketing play for the next probably couple weeks or so, maybe couple months. Um, get people on the platform, get them used to using it, get the market large, and then make it to the point where Jupiter is the go-to platform for lending and borrowing on the Solana network.
Now,
Well, I'll tell
Mike.
you really quick, David. What kind of came to my mind when I saw this, and especially this specific screen, was when we were doing the looping strategy video with Pendle and Contango, to where you just the stark contrast, like you gentlemen have just kind of detailed, between the supply rate and the borrow rate.
Right. And so one of the opportunities here, Mike, that looks really interesting because it looks like the majority of the yield when you lend is paid in rewards and not the native APY. When you go to multiply, let's say you want to supply syrup USDC and borrow USDC against it. Well, you're going to earn that native 7% on the syrup USDC, but to borrow, you're only paying 0.7% net borrow APY to borrow USDC. So if you use max leverage, this is on stables. You could do 50% APY on stables. That's a pretty great looping opportunity right there. And
Yep.
it's because of those rewards, I think.
Yep. I'm currently on ramping some capital. I just bought $10,000 of USDC.
See, there you go, man.
Let's just go ahead and keep talking. I'm going to get some liquidity on here real quick.
Oh man, yeah, you guys end up. No, yeah, no. I think these are definitely very appealing vaults. And again, David, to your point, like how long will this last? And also, will they let us know? Like how much notice will we have before it flips? Like, is it going to be one day we log on and we go from doing our, point or 0.7% borrow rate to all of a sudden it's 5%? Or is it going to be like going from what do you call it? 0.7 to like 1 to 1.5. Is it going to taper, right? That's the main question I have, and I'm kind of curious. So,
And I'm sorry, when I was talking about Pendle before, I think I skipped over my point. But the thing it reminded me of is
oh,
Oh,
we
looks
got
like,
the daily cutout for Mike.
yeah, I guess, one of those fast moving trees just got in
Yeah.
the way of his satellite.
Yep.
oh damn, my satellite. So
Yeah.
basically, the point I was trying to make before with Pendle that I think I skipped over was that when we were doing that video with the Pendle and Contango looping, some of those positions that you were looking at, you said you were looking at them for like 60 or 90 days. So you're only going to be in those for around 60 or 90 days. And so I kind of, when I saw this in our mastermind group that we were in live, right before we went live with this, brought this up where, hey, in a month, is this going to go away in 2 months? And in my mind, I'm like, as long as it's not ETH mainnet where there's like a huge fee or something, getting into this for a month or 2 months might not be a bad play. Just milk the incentives, and if it does drop off, pull your liquidity. So I mean, is there either of you see any downside to that, or?
I mean, the
Yeah.
downside is, as I mentioned, like if they do a big drop on us where they just go like from 0.7 to like 5% or something. Like obviously,
Right.
if you aren't paying attention to it, you're
Mm.
not checking it every day, every other day, right? Um, you could easily end up being like, oh shoot, like all of a sudden this strategy is negative. What's going on? Or oh shoot,
Mm.
it's 1% or something like that. So yeah, and also, as more TVL comes in, obviously those yields are going to go down because they can't just
So it
pay
looks
out
like
forever.
J Utah MB says that they're being very transparent in their Discord. So maybe that's the play, is to get into Jupe's Discord and make sure that you're keeping track of any potential where they're going to start tapering this back.
Yeah.
Yeah, I think that the core risk here is interest rate risk because nothing here is fixed. And most of what you earn on the collateral side seems to be incentives or rewards. So if those rewards dry up, you really need to have a window into the utilization rates for all of these different vaults or multiplication pairs, multiply pairs. And so when I take a look at the statistics tab and I take a look at liquidity and borrow and earn, and I want to figure out how much in this USDC vault, what's the utilization? What does that look like? Um, it's brand new. And the data that I'm looking at, it's not quite enough data for me to
Ru-
be
Looks
confident
like,
yet.
it looks like roughly half. So total available is 215 million. Total borrowed is 102 million.
Right, right. And so if you, Mike, if you dig in, so if you're in the statistics tab, and
Yeah.
then if you click on liquidity, and then if you just click on, let's say, USDC.
All right.
So the type of reporting that I'm looking for here, I'm looking for something that is more closely resembles Aave's data. And this doesn't quite get there. It's close. But to Jake's point about when will the incentives run out, when will the rewards run out? Well, when those incentives and rewards run out, I want to know how quickly the utilization in these vaults is going to move because that's going to change the APY that I'm paying to borrow, and it's definitely going to change whatever I'm earning on my collateral. So without a window into the data, without being able to see the data, well enough, it's just kind of difficult to make a decision. And I know this is brand new, and I like what I see so far. But yeah, I would just be cautious with this, just because it's new.
Yeah.
No, absolutely. And there isn't historical data because I mean this is new. So
Right,
all
right.
of this stuff looks like a hockey stick.
Yeah, 100%. Well, I can be the data guys. I will let you know how it goes.
Yeah,
I
let
got
us know.
I got 10 grand flowing over to
You're,
Jupiter right now,
you're
so
the Jake's going to be the canary in the coal mine. And we're gonna if Jake loses his liquidity, then we'll all get out of the mine.
I'm gonna get liquidated.
Yeah.
I'm portal bridging. Awesome.
Our sacrificial lamb, Jake. Come on.
Well, yeah, I mean, I'm gonna try it out. I think it'll be interesting. Again, these multiply strategies look great. Remember, they are showing max net APY. Max net APY assumes you're using 7.91x leverage. I had a time where I was 5 grand over on Aave, doing lending and borrowing arbitrage. FTX collapsed. USDC got hit by like 1% or something like that. I got liquidated. I lost 2 grand on 5 grand or so, down 40%. So you live and you learn, but I'm not going to be doing a 7.91x multiplier. I will happily take maybe 30% on these stable coins, to be safer, basically. So yeah, especially if this borrow rate, no, that's the other thing I wanted to cover. If this borrow rate does shoot up, and all of a sudden you're borrowing for a higher rate than you're supplying because incentives go down for one, borrow rate goes up for one, because these could easily adapt very, very quickly depending on where people are depositing. Your borrow could overcome your collateral very, very quickly and cause you to get liquidated. Is another thing because of the immense borrow rate that you might be paying. So
Oh, so I actually I didn't even think of that.
yeah, so
So
it's not just your collateral going down; it's also your borrow going up compared to your collateral.
oh, okay. No, that's. I mean, yeah. I mean, actually, you know what? Could you dive into that a little bit more? Because that's not something that I'll be honest. That's not something I really thought about when it comes to the stable coins, especially with my strategy that I plan on doing. I just really thought that all right, stable coins are pretty stable, and if I only took out say 30%, loan to value,
Mhm.
that would be a pretty safe bet. But you're saying if for whatever reason, if I'm looping and my lend borrow, goes lopsided, that can throw me out and get me liquidated as well.
Yeah. So if I could share my screen real quick, Mike.
Yeah, please do.
let's just say we were lending out one BTC, right? And I'm going to use BTC for this example, and then we'll translate it to stable coins. And current price BTC is worth, say, $110,000 right now. Well, then our lend right now is a total of $110,000. And let's just say we go and we borrow like a pretty high LTV, and this is in USDC. We borrow 80,000 USDC tokens, which is equivalent to, $80,000 basically, which we'll just do the same math right over here. Obviously, if this lend goes down, our collateral, our Bitcoin price goes down. Bitcoin's now like $90,000. We're probably going to be liquidated at this point because we're borrowing 80 grand against 90 grand. And
Okay. Yeah.
Jupiter is going to end up liquidating us to make sure that we can pay it. But this can also happen the opposite way. So one of the ways I like to look at it is, let's just say we completely flip this. So we are essentially borrowing BTC. And in this instance, let's say we're borrowing $110,000 of BTC.
Hey, could you do me a favor real quick? Like do this scenario using stable coins where
Okay.
you're lending stables then borrowing stables.
Okay. Yeah. Yeah.
Just because I mean they're equal, dollar amounts, so it might make more sense to people.
Yeah. 100%. So if we're doing something like this, Syrup to USDC and then USDC pool. We'll do Syrup USDC to USDC. We lend out 100 grand of Syrup USDC. We borrow, in this instance, I'm not sure the exact amount, but maybe it's something like $95,000. Again, not sure on the exact amount that it will be. We can go into the calculations on that, but we're borrowing 95 against 100. Now, platforms like this, like Jupiter, Aave, Compound, Morpho, all these, they have something called like efficiency mode, where you can borrow at a very high loan to value against same assets. So we can borrow ETH against staked ETH at like a 97% loan to value, I believe it is. Same thing, USDT against USDC, stuff like that. Because they're the same asset, they have the same price, or at least they trace the same price. But again, if there are specific aspects where the market price just slightly adjusts, not the collateral price, just the market price slightly adjusts, because maybe there's a big sell, right, of a whale just dumping a ton of USDC or something like that, then that can cause you to get liquidated. So in the instance where Syrup USDC, and let's say the max loan to value, the liquidation threshold is 96%, right? Our current loan to value here is 95%. We get that by dividing the borrow by the lend, right? And if max loan to value before liquidation is, let's just say, 96%, right? Well, what happens when maybe this Syrup to USDC fluctuates a little bit? Now that's $99,000, just a small move in that. And maybe a small move in USDC. That goes up a little bit to 95,500 now. Boom, you're liquidated because you're
Oh,
0.5% over, right? But the other concern is what happens if this $95,000 just goes up to 96,000 because we're paying interest, and our interest is accumulated by our borrow going up. So you might start with 95,000, and your borrow just goes up and up and up and up every single day to pay the interest, right? You just have to pay more back. That's kind of how these platforms work. But like that's one of the concerns. So if you are doing a max loan to value over here, right, of this whatever, this max leverage of 7.91 x, then you obviously have to be very, very careful, because if there's a slight adjustment between Syrup USDC and the actual price or USDC, you're going to have some issues.
so it sounds like the moral of this story is keep a very low, healthy loan to value ratio.
Exactly. Yep. Exactly. Yeah.
All right.
Yeah.
You have anything to add to that, David?
Yeah, sure. So here, let me take over the screen share for just a second, and
All right.
let's hop in. Let me just share my entire screen, and then let's go on over to Trading View real quick, so that I can bring up just a clean chart, and that way I can draw on it. So when I'm supplying or borrowing assets on a money market, I want to use this cross as an example. So the S is the supply side, and the B is the borrow side. So there are a couple of ways that I can lose. So if we're talking about supplying syrup, that's supposed to be a syrup. That was pretty awful. I'm going to delete that. Let's just call it syrup USDC, SUSDC. That's syrup USDC. If I'm supplying this and I'm earning 7% to supply it, and then I'm borrowing USDC against it, and because of the incentives, I'm only paying 0.7% to borrow that USDC. Well, my net interest margin is 6.3%. So that's pretty darn good, right? And then if I use some leverage, then I can earn multiples of that 6.3%. So if I use max leverage, according to Jupiter, I could get close to 50% out of this interest rate arbitrage. That's what this is. This is an interest rate arbitrage play. Now, what are the risks here? Well, one of the risks is interest rate risk. So your yield on syrup USDC is not fixed. If your yield on your collateral goes down, well, then the loop will pay you less. Same thing is true on the debt side. If what you're paying to borrow USDC goes up, well, then if what you're earning on your collateral doesn't move, but what you're paying to borrow does, like the interest rate on what you're paying to borrow goes up, then your arbitrage play becomes less profitable. Now, let's say worst case scenario, what you're earning on your collateral goes down from 7% to 5%, and what you're paying to borrow goes from 0.7% to an average borrow APY for USDC on a liquid money market of, I don't know, let's call it 4.5%. So if suddenly you're paying 4.5% to borrow and you're only earning 5% on your collateral and you've multiplied by a ton of leverage, you may still have a profitable position, a profitable trade, but just barely. And so let's say worst case scenario, the borrow APY here goes from 0.7% on your USDC to, instead of 4.5%, let's say it goes to 8.5%. And then let's say over here on your collateral side, what you're earning on that syrup USDC doesn't move, stays at 7%. Well, if you're paying
unwind that loop and pay off those loans.
Well, yes, exactly right. So this would be, an arbitrage. You would be paying the carry. You don't want to do that. Now, how long would it take for you to get liquidated in something like this? It would probably take months. If this condition persisted like this and you're paying 1%, the liquidation period could probably be measured in months. But this isn't the only risk, though. And Jake mentioned another risk, which is DPEG risk. Stables move too. Just because they're stables and pegged to, one or pegged to the dollar or maybe yield bearing in some way, doesn't mean that they can't have DPEG events. So if I'm supplying syrup USDC,
It happened to USDC and I believe USDT during the bear market.
Exactly right. And USDC depegged to the downside in 2023 because they had a bunch of collateral at Silicon Valley Bank. They had like $2 or $3 billion at SVB. I don't know why they were keeping $2 or $3 billion at SVB, but they were. And so that
I think the big reason is because of kind of the war on crypto. There wasn't a whole lot of banks where crypto companies could put their money. So I think
True.
it was one of the few in the nation just to put the information out there.
No, you're right. You're right. And so the core risk, the DPEG risk, so when you're in these arbitrage plays, you make money slowly, but you can lose money really quickly. So if your collateral DPEGs to the downside and your debt doesn't move, then depending on the size of the DPEG and whatever the TWAP oracle is that the money market is using, a DPEG in your collateral to the downside could get you liquidated like that. The exact opposite is true with your debt. A DPEG in the debt to the upside when your collateral doesn't move, that could get you liquidated.
Mm.
So you've got two risks. You've got the interest rate risk, and then you've got the like the underlying, like the DPEG risk. So the core takeaway is you've really got to have some great analytics coming from Jupiter. Jupiter has to give me more information about this borrow APR. And I know that this just launched. And, look, don't get me wrong, this looks like an amazing opportunity. And it's probably going to fill quickly. Already, 31% filled on this vault. So get in while you can, but understand the risks. So
Yeah.
So let me know if this is an accurate summary to mitigate risk in this scenario with the stables. Um, so basically, if say I just used low leverage, or just a low loan to value, and made sure that part of my morning routine, while I'm drinking my coffee or whatever, I am going and checking on my positions, making sure that they stay healthy. I mean, you think that would be a pretty good way to mitigate the risk on these types of positions.
Yep. Yep. And I wanted to show you real quick. I was going to open this position so we can just open it live here. But a couple things, and Jupiter does a great job at showing this. And I also love when platforms have like multiply because they know people are going to loop either way. So they're like, we might as well make it easier for people to loop. You know,
Yeah.
um,
yeah.
and
Actually,
it's
real quick, I have a question. So multiplying for people that aren't as knowledgeable, multiplying that is basically looping. So if I do like a 2x multiplier, that's like looping twice.
Yeah, it's
Okay.
it's interest rate arbitrage basically.
Okay.
So what you're doing is you're lending out, you're borrowing, you're lending out, you're borrowing, you're lending out, you're
Mm.
borrowing. Aave doesn't have this functionality, so you can do it through like Instadap. You can do it through DeFi Saver. Those are two popular tools. But on specific platforms like Jupiter Lend, they just let you do it directly through the platform. Because they'd rather you use them as opposed to a third party. But when we're looking at this, so I have about $97.65 in 8710 syrup USDC, which is yield bearing on its own, I believe, right, David?
Correct, 7%.
Yeah, 7%. So, um, yeah, and that's another thing, actually. You're getting no supply APY here. You're just getting the native APY. You're not getting any additional incentives for syrup USDC in specific. So do keep that in mind. But when we look at this over here, there's already only 25K to be able to borrow. So me going in with 9765, I can do like a maximum of around 3x leverage before it doesn't let me get in because I'm borrowing too much. And as I drag this leverage slider, and if we just start off at like 1x leverage, you could see I start by basically just supplying this. It, for some reason, won't let me go to 1x leverage. But I'm just supplying. I'm not earning, or sorry, I'm not borrowing anything like that. But as we turn up that leverage slider, you can see that debt right here starts to go up. Okay, but at the same time, my supply is going up because as that debt goes up, it's taking that debt and it's swapping it to Syrup USDC, and it's putting that Syrup USDC back on the lending market. So if we're at max leverage over here, you could see if Syrup USDC reaches a price of 1.0929 USDC, so it drops by 2.2%, my position could be partially liquidated, right? That right there is the concern. We're borrowing $67,336 in USDC against roughly, I want to say 70 something thousand dollars. So it's obviously a little bit of a risk just doing max leverage, nor can we do it on this size right now. But what I will do is I will just do the max leverage it allows me to do, which is also kind of where I'd be looking at shall I wanted to even if we had the max available. So 3.6 I think is a relatively safe thing because Syrup USDC would have to drop by 19% in order to get me liquidated here.
So
Um,
Jake, let me interrupt you for just a second. Something that I really like to do when I'm performing this exact operation that you're going through now is I like to take a look at the chart of the yield bearing collateral asset
yep.
because I want to see Syrup USDC in the past, has it depegged? If so, to the upside or the downside, and by how much?
Downside.
Right over here. Right over here.
And how
So
much was that in
111,
percentage terms?
111 to 108. So let's say 112 to 107, right? 4.4%. So when we think about it, right, using that max leverage, right, going in with 7.9x, as we saw, if it drops by 2% or 2.2%, it was, we can be partially liquidated. Well, what do you think dropping by 4% or 4.5% is going to do to your position, right? Even over here when we see minor moves, that right there is why we cannot just ape in, turn on max leverage, be like, oh, it's stable coins, all good, right? No.
Exactly.
So instead, right, we have to drop by 19%. And as David said, piggybacking on top of that, what happens when we drop 19%? So we'll multiply that by 19%, and then we'll subtract that from the current price, which would put us at 90 cents, right? And if we look at the past year over here, Syrup USDC has never been at 90 cents, and it's only been around since March 2nd. Keep in mind, but it's never been at 90 cents, which tells me that I feel safe using 3.6x leverage. I'd feel safe using probably 4.25, but I probably wouldn't go past 4.5. I think that's where I draw the line on this one. But just for reference, we hit create position, confirm it in the wallet as per usual. I think everybody probably knows how to do this,
Yeah.
but
And so you're getting 20. I can't quite read that. Is it 23?
23.3, which is
Dude,
better than all the other,
23. That's great.
better than all the other stuff I'm doing. So yeah, and I have about 35 in other stablecoins positions right now, and I've just been bringing on new capital. I was gonna get 15 in here, but unfortunately, Coinbase only let me send a portion, and I only had some other uh, in my wallet. So yeah, just like that, we're opened, and that's the great part about platforms like what do you call it? Jupiter, because they allow us to do this looping process directly through their platform, and they allow us to track it. So if Jupiter is anything like, let's see, anything like Camino, and it might not be actually.
Yeah, I really want to see the portfolio, what it looks like in the portfolio tracker there.
Let's see. Um, that's actually my wallet. Here we are. So we have our health ratio. We don't have much in terms of actual profit loss data or anything like that, unfortunately.
Do you think that maybe, okay, so for yield, it doesn't show anything for Syrup USDC, but it shouldn't because you're earning that native yield of 7%. For
Yeah,
the
which
USDC, you're paying, what is that, 2 point something?
2.62%.
Right, but where does it show the incentives, I wonder? Because there's that reward incentive, right?
Well, I don't think there's a reward incentive for Syrup USDC. So like when we look
For
at
the
these
debt
ones,
side, for the USDC, for the borrow side on the multiply, wasn't there some type of USDC incentive there?
let's see.
You
I
see where it
don't
says 0.7 up
uh
top on your borrow rate for the open position?
USDC rewards APY minus 2%. So okay, so that's interesting because it doesn't show that over there.
Right.
So yeah, our net borrow APY is 0.7% because it's probably giving us a rebate in USDC. So we can check back over here in a couple David, it might just pay down the borrow a little bit.
I kind of think it probably would.
Yeah.
But yeah, always when you open a new position, a test position on a protocol like this or new functionality, I always
Mhm.
like to see the UI, give it a couple of days, sometimes a couple of weeks to, really get a better feel for it.
Mhm.
And I mean, Jake, this looks great, man. I really
Yeah.
like this functionality.
I love the user experience.
Yeah.
Yep.
Awesome. Well, we only have a couple minutes left. I want to make sure we get to it. But for closing thoughts, both of you, what are your three top altcoin picks, and just briefly why? David, go ahead.
Alrighty. So my top three alts. Well, I really like hype. I love trading on Hyperliquid. I like the growth of Hyper EVM. I like all of the new dApps that are being built there, and I like the deflationary mechanism built into hype. And very bullish on hype. I also like EtherFi. and their ETHFi token. I live off of my DeFi portfolio, and using the EtherFi credit card, that's how I pay for everything in real life. And 3% cash back on that is phenomenally good on every
Yeah.
purchase. And that ETHFi token returns revenue to token holders with a buyback mechanism. So, or a burn, or maybe you could call it like a token repurchase mechanism. So, what I'm looking for here is, number one, I'm looking for businesses. So, I'm looking for protocols that are successful businesses. Number two, I'm looking for tokens that return revenue to token holders in some way. So, I think that's true for Hype. I think that's true for ETHFi. And for number three, oh man, if I had to just choose three, it would be a tough choice between some type of an AI name and a meme. I think that the AI tokens. I mean, I'll go with Tau. Because I think that Tau, number one, it's a layer one, okay, and it seems to be this ecosystem of AI businesses, like intelligence businesses, where you can almost swap into an alpha token, which represents a share of those businesses on the BitTensor Tau layer one. So that's a very interesting layer one. And it's at the top of the list when it comes to market cap in anywhere you look for AI stuff. So I would go with Hype, I would go with ETHFi, and I would go with Tau. Yeah,
Awesome.
those are my top three
Jake,
right now.
what are
Yeah.
yours?
So as far as what I'm going with, I'm gonna go with Hype as well. I'm gonna steal it from you, David. No, I really like Hype because they've, as you mentioned, built an entire ecosystem around it. It's not just the Hyperliquid platform. That was already good enough for me, right? But then they bring on Hyper EVM, and then also I really like how they're supporting projects without supporting projects on Hyperliquid. In other words, they're not like, where these big name projects just get a ton of incentives and all the little name projects get no room to grow, right? Like we've seen on a plethora of chains, right? With, ARB incentives and stuff like that. Projects that already have a ton of money get more money, and the little guys don't get anything, or they barely get any allocation of tokens. So I really like that. And then the other thing is, or I guess the other token after Hype would be um, probably Aether is going to be a big one. Aether, it's been a little bit
Deepen.
of AETHIR. Been a little bit of a slow performer recently. Um, but again, as David said, real world business. They essentially generate a ton of revenue. I think they have like 100 million in annualized revenue. They were a business before they came on the blockchain. And they completely skyrocketed once they got on the blockchain. Um, and yeah, they kind of reinvest. So their model is like people pay for GPU cloud computing, and a lot of it is AI projects. They pay for it in Aether, and that Aether is either burned, it's sent to the people that are running the nodes, it's taken out of circulation. It's what do you call it? Sometimes if they get like people paying in non-Aether tokens, they do buybacks with that, so they use that cash to buy Aether token, therefore raising the price. There's lots of different mechanisms in place to inject it back into the ecosystem, basically. But the point is, they use it to grow the token's value, right? As opposed to pocketing it for themselves. Um, and then again, like another one for a third one, I like Ondo just because it's in the real world asset space. It's a large, large platform. They're starting to expand their horizon, and yeah.
Well, it sounds like in a lot of ways, we think alike. Ondo is my second largest hold. Just because of the tokenization aspect. If you keep an eye on any of the the data and the news and just the stock market is they're already knee deep in tokenizing stocks,
Mhm.
private credit, real estate, just everything that's illiquid, they're making it liquid. So RWA and DeFi plays for me are pretty much my portfolio, but Ondo is one of those. One that is a little less known is Plume. And if you look at the price of Plume, you might not be that bullish, but if you dig and start seeing their ecosystem and who they're partnered with, Hyperliquid is one of the ones they're partnered with. Centrifuge, another tokenization play they're partnered with. There's BlackRock, the Nest Protocol. Is one of the tokenized RWA platforms or protocols that's on Plume Network, and it just has all kinds of stuff, commodities and just all kinds of tokenized real world assets. So Plume is one that I'm definitely keeping an eye on and have been for a while, and it's actually one that I churned $800 into 8 grand over the past couple of months just from using liquidity pools. It trends sideways a lot. So
Mhm.
basically, there's three ranges that it's ranged in since it went live, and all the while we've just been racking it up with tight ranges. But and then I know it's one that both of you aren't a huge fan of, but Aerodrome. I'm a huge fan of Aerodrome, just because I understand that as those new tokens are minted, they're either paid out to locks and immediately locked. They are max locked. Anything that's not paid out, and then it's paid out in incentives as flight school bonuses, which are also locked. So they're not, the inflationary aspect isn't fully realized right now. So at least in the short term, I'm very bullish. And the way that it's being positioned with Coinbase and the Base app, and since Aerodrome is over around 60% of the volume that's on the Base chain, I just see, and there's all kinds of other partnerships and RWAs that are going to be filtered through it as well. I see a ton of upside to it. So short term and personally long term. That's why I have my locks.
Oh, looks like he locked out.
Another one. trees, trees are getting Mike.
I know, man. I like Arrow. I think that Arrow will probably do well too.
I think he'll do well, right? It's just a question of like it's one of those based, in my opinion, more on speculation. Not saying it's entirely based on speculation,
Hmm.
more on speculation compared to some of these other assets, which are like pretty simple. Like we make money, we buy back token, we burn token. Like
Yeah,
that.
yeah.
Exactly.
It's more complex. Tries to keep you in
No,
the
no,
and
and
stuff
and
like that.
I love the conversation that we had. I detest having conversations like this where everyone just agrees with each other and it's just like this little echo chamber. I love it when there's people that are pointing out the kind of the opposing view, because it really makes you dig in and examine your thesis on your positions, or your beliefs on your positions, which is healthy. If you can't defend your logic or your thesis on an investment, usually means you haven't done enough looking into the fundamentals or enough research. So again, I very much appreciate your opposing views on Arrow, because it actually made me go back and redig and make sure that I still felt the way I did about that investment. So thank you to both of you.
Yeah, of course.
Of course.
But I want to be respectful of your guys' time. I know, David, I think you have a call after this. So thank you, gentlemen, both for being here. As always, I immensely enjoyed this conversation and learned quite a bit. I hope everyone out there also did. But till next time.
Can I
Oh, yeah.
shill something real quick, Mike?
You know what? Shill away, brother.
I only say this because we partnered with Matcha. I think I mentioned this before. They gave us $1,000 for like some type of sponsorship. I'll just share my screen real quick. And we're like, hey, we don't want to just take this $1,000. Like we don't need it. We'd rather figure out some way to make this beneficial for our community. In our free community, we're giving away $1,000. Um, and I think some of the people in here are from the free community, so it's great to see that. There's one grand prize winner of 300 USDC, and 5 submissions get 140 USDC. I believe we have 9 submissions right now. So you have like 3 days to have a very high probability of getting at least $140 of USDC, which is the only reason why I want to plug it.
Well,
Um,
then you shouldn't have told everybody about it. Just told me, man.
but it's very simple, and I won't take too much of your guys' time. All you have to do is like there's a quick submission template. Go into the comments and just outline your strategy, whether it's with a specific position, specific pair. Like hey, I'm accumulating more Bitcoin by doing XYZ, basically. There's like a ton of different comments. And also, if you look at this, 9 submissions, but 67 comments. That's because people are getting feedback on their strategy. As you can see, our team's diving in, they're diving back in. And there's an actual conversation flowing here. So not only is there like an opportunity to get, 140 USDC or more, there's an opportunity to learn and learn from others. So I don't know where I could throw a link. Maybe if you just go to builderwealth.com/liquidity-syndicate, right? /liquidity-syndicate, it will just prompt you to log in with your metrics account. If you don't have a metrics account, email, send you a one-time password. You're
If you
in.
want to, if you want to send it to me, I'll add it to this
Yeah,
episode.
we'll do. I appreciate it, Mike.
No problem.
Yeah, and go get some free money, guys. And that tells us that Matcha would want to do more of these in the future. Other projects want to do more of these in the future, and we give away more money. So that's it for me. I'm done chilling.
All right, man. Yeah, I appreciate you. But with that, thank you again, gentlemen. I appreciate you. And until next time, Veteran Crypto out.
Peace.